All right, Gerard, welcome back to Real Vision.
Thank you.
Great to have you.
Thanks for having me.
Shall we kick off with an update on Oz?
Sure. It's getting interesting.
It is.
The bears have known the outline of the bear case for some time, which is quite simply the world's most expensive housing stock, I guess outside some small city-states, a hugely indebted consumer that has no saving, and a Reserve Bank that's got very little room to respond if anything goes wrong. Now, they're the outlines. There have been some positives that have kept us away from the precipice for some time. And what I'd focus on over the last 4 or 5 years is first and foremost population growth. It just keeps the wheels turning over. It means that it's not clear we have a huge excess supply in housing. I'll give you one stat. The rental vacancy rate is below average and falling. It's generating demand for infrastructure, and here we are in Sydney and all the roads are being dug up as part of the spending that's doing. So that's an offset. Another important offset is the mining capex boom, and it did boom, then bust, but the bust has almost run its course. So mining capex as a share of GDP went to 9% at its peak. It's now back at a little below 3%, so it's subtracted 6% from GDP over the last 4 or 5 years, but that's probably now the floor for it. And there's a few other positives you can throw into the mix, such as we continue to debauch our tertiary sector, and that means more foreign students. And statistically, by selling a lot of LNG, it will add to GDP growth, although it's fairly calorie-light growth. It's not going to add much to anything. So what we've been going through for the last, 18 months is the housing market starting to soften with the consequences that growth is starting to weaken, but we've been kept afloat by these positives. What's happened over the last quarter or two is we're seeing signs that the downdraft in housing, borrowing and wealth effects are starting to build steam, and that's making it increasingly likely that there'll be a recession. Now, I'm not making recession my investment base case yet, but if we were to get another 2 or 3 months of data like the sort we've had over the last 2 or 3 months, then I think investors should make recession their investment base case in Australia. And if we were to see a recession, trust me, it would be world's best practice. This would be a disaster given how indebted we are, how expensive our asset prices are, and the inability of policymakers to respond. That's if we get a recession. So what's the odds? Well, the things to watch: supply of finance to housing. When you have house prices as high as they are in Australia, the demand for housing is just a function of the supply of credit. House prices themselves. Building approvals. Now, despite the population growth, the fall in approvals over the last 4 months has been large enough to suggest that residential construction will probably subtract about 1% from GDP over the next 12 months. But then the big one, but this is also the big unknown, is the wealth effect. So it's quite clear that because house prices have been on this rampant bull market for some time, Australians have been willing to reduce their saving. According to the Bureau of Stats, we're now saving about 2 percentage points of our disposable income. But it's worth recalling that on the income side, the statistician includes the compulsory pension contributions that employers make. Now, once you take that into account and sort of, in a sense, pull them out of the numbers, the saving rate's effectively negative. If you're saying, well, how much do you save out of what you actually trouser every week? I'm actually overspending. So if the wealth effect is strong enough, in other words, if people adjust upwards their saving rate fast enough as house prices fall, then we're toast. In particular, if we follow the pattern that we saw of economies that experienced material house price bubbles, then busts in the GFC, what they saw on average was around about a 2.5 percentage point increase in household saving year 2 and 3 after the house price peak. Interestingly, the saving rate continued to fall for about a year after the house prices peaked in the GFC, much as the saving rate continued to fall in Australia last year, even though house prices were falling. If we see that 2.5 percentage point adjustment, that by definition means spending has to grow lower than income. The trouble is, in Australia at the moment, real aggregate disposable income growth is roughly zero. So if you're going to increase your saving with no income growth, you've got to cut your spending. So that is the recession scenario. And interestingly, if you're looking for early hints that it's starting to unfold, if you look at spending at the state level, and I like to look at spending per person so that I don't get confused by some of the interstate migration numbers. Spending over the course of last year in Western Australia, capital city's Perth, fell. Now what's interesting about that is house prices in Western Australia, both in Perth and the regions, have been falling for 2 or 3 years. In other words, if anybody in Australia is at the stage where household saving rates are starting to drift up, it's the West Australians. Now, this is circumstantial evidence. I have to use that because the statistician doesn't publish state-level saving rate data, so I can't just reference that. But it's interesting that it's clear that consumers are weaker in Western Australia on a per capita basis than anywhere else, and they are further into this house price decline than anywhere else. And if the rest of the country follows that pattern, things will get worse in the second half of the year. And as I said, investors need to make a recession their investment base case.
Do you think the Royal Commission let the banks off?
I don't think the Royal Commission did, but I suspect the politicians have. Speaking from the man on the street, it was just staggering to find out just how big a gap it is between punishments when you rob a bank versus when the bank robs you. I tell you what, if I was ripping hundreds of millions of bucks off people, I wouldn't be getting a rap across the knuckles, and please don't do that again from the regulator. So even if we don't crack down hard on the banks for what they have done, surely they're aware now that every politician would love to hang one of them high in a tree for something they do going forward. And you would think that that's one reason we're seeing this credit contraction, that guess what? They're actually starting to check things. And one of the other surprises from the Royal Commission was that, yes, we do have a lot of liar loans in Australia, but unlike in America where the lying was done by the borrowers, here more often than not was done by the lenders.
Or an intermediary, I suppose.
Or intermediaries, their agents, that's right. So that's part of the reason we've got this decline in credit provision, which is feeding directly through into weaker house prices.
It seemed to be happening before the Royal Commission, though.
It started. I think that's because if you look at the detailed numbers, the initial decline in credit approvals was for investors.
Right.
And initially that was a desire of the Reserve Bank and APRA in particular to slow the lending for investment properties, and they did actually put a cap on it. Now that started to come into impact 2.5, 3 years ago. The new news just over the last 6 months has been the rolling over in lending for owner-occupiers. So this is upgraders. And that's where the Royal Commission fingerprints are all over that. Now the uncertainty is this. Is that recent decline, which started September, we only have data up until January, is that a permanent tightening of credit standards, and will we continue to see credit aggregates continue to slow? Or is it simply they've put in place new processes that are extending the loan approval system, and what we're simply observing at the moment is an air pocket? But once people get through this more extended process, the flow will resume at a more normal rate in a couple of months.
For a soft landing?
That's your soft landing scenario. That's where your credit approvals start to inflect, move a little higher in the next couple of months. If, there's going to be a few ifs in this, but if after that you then get people going, you beauty, house prices are 10, 15% lower now than they were at their peak, so I'm now willing to borrow again and put a floor under it. This is against a backdrop of still a decent unemployment rate, i.e. low. That's your soft landing scenario. That's where we start to see the nosedive in house prices inflect. We then get a sense that house prices peak to trough nationally will not be falling 20%, they'll be falling perhaps at 15%. But once you get that sense of soft landing with a few other goodies from the government, we have a slowdown. I mean, we don't avoid a slowdown here, but we don't get it tipping over the edge to job losses. Once you get job losses, that's the dynamite stick into the pond, because there's going to be a few things float up. And it's worth recalling in Australia that what we are now seeing with house prices declining is the first decline in nationwide house prices not associated with either RBA rate increases or a rise in unemployment. Now, if we were to get either of those things, we won't be getting RBA rate increases.
That's for sure.
You start the rinse and repeat cycle all over again.
Yep.
You get a second leg down in house prices. And my view is without any rise in unemployment, we're probably talking about a 15 to 20% peak to trough decline in capital city house prices.
Which is the average in previous downturns, right? Ish.
It's at the high end. It's at the high end. But yeah, I mean, it's not unprecedented. It's at the high end. If we were to get job losses...
Which is green shooty at the moment. It's not, the rate of change is not particularly...
In employment?
Yeah.
No, it's okay, but I can point you to a couple of things. Some of the leading indicators are starting to weaken. If you look at hiring intentions in individual corporate surveys, if you look at job advertisements, either the ANZ or the government series, which just counts the number of vacancies, they're clearly turning over. They're not yet at the stage of signalling outright job declines. Where you can see evidence that we're likely to see outright job declines is actually now in the construction sector. Because guess what? Building approvals gives a pretty good lead on how many tradies are going to be in employment about 9 to 12 months ahead of time. And where we are now, it looks like you will see construction sector employment decline later this year. Now, they punch above their weight because these are better paid jobs. So there probably will be some weakness, but I do agree with you. I'm not yet at the stage of being able to point to leading indicators that tell you you will see aggregate economy-wide job losses. They're not there yet. And that's why the intermediate stage you need to go through is the wealth effect to weaken the consumer. Then you are likely to see those leading indicators roll over. And that's why recession starts to become the base case. We're not there yet.
When we are there, your favourite short, it would be the currency or the banks, or banks until before a dividend cut?
Have I got an option of all of the above?
Yes.
Look, I mean, I think if we had a recession, cash rate to zero,
Yep.
10-year treasury below 1%, the Aussie dollar to 60, and the banks get smoked. Now, the sequencing, I mean, the RBA cuts probably, I guess, come first. We're at 150 basis points with the cash rate target, but of course the market's already pricing in a couple of rate cuts. So it's almost as if now just simply to have more of the same, more of this tepid, anemic growth, which probably does get 1 or 2 RBA rate cuts this year, is what's in the price. To be bullish on Aussie short rates, you need increasingly to make recession your base case, so they push the cash rate below 1, which they for sure would under a recession scenario. The currency give way. Now, what's already interesting about the Aussie dollar is if you look at how it's traded over the last 6 months versus its usual commodity price barometers, it's actually underperformed.
Massively versus iron ore.
That's right, specifically iron ore, but if you took a broader basket, it's still underperformed. If you look at how it's performed vis-a-vis interest rate differentials, and I always like to use not the spot cash rate targets, I use the futures, so that captures the anticipation of policy changes. The currency has been stronger than you would have expected. So obviously what we're seeing at the moment is this tug of war in the Aussie dollar behind, on the one hand, the currency differential, which is pointing to a lower currency, and commodity prices pointing to a higher one. But in a recession, it's not just an interest rate differential story that starts to drive the currency, it's concerns about credit and people actively taking short positions as opposed to just scaling back some pre-existing long positions.
Well, it's kind of likely to be a global recession, and it's going to be a race to the bottom, right, for currencies. So.
Well, what's interesting here under my worldview at the moment is this could be the first unilateral or solo Australian recession.
Ever?
Well, the 1961 credit crunch is arguably it, Bob Menzies' credit crunch. But no, it'd be very interesting. It's interesting from an equity perspective because the Aussie dollar in a recession, a global recession, is obviously high beta. So commodity prices get sold off, the currency's down. If you're a local fund manager with an ASX 200 benchmark, your natural preference is to go to stocks that have foreign currency exposure, but not the miners. because it's a global recession, their commodity prices are getting hit. Whereas interestingly, this could be almost the perfect barbell scenario for being long the miners because their commodity prices may hold up and you get the benefit of the Aussie dollar down versus the banks because in this scenario, it's where they cut their dividend. And I mean, one thing I think is underappreciated by some offshore investors with our so-called franking or dividend imputation system, just how attractive equity offering a 7% dividend yield is to a local like myself.
Franking.
Yeah. If I buy a company on a 7% dividend yield and assuming they're paying the full freight on the corporate tax rate and I'm on the top tax bracket, that's like a pre-tax yield to me of low double digit. Now, with a lot of self-managed superannuation or pension accounts buying stocks with those characteristics, that offers a lot of support. And if you look at the banking sector over the last 2 or 3 years, and it has been underperforming versus the local benchmark for that period, it keeps on bouncing off a dividend yield of 7%. And that's your support under the soft landing scenario. But the converse is, if a lot of people are holding an equity because it pays a dividend, and then it cuts its dividend,
Telstra?
It's all over. Now, it's not broke,
Yeah.
but it's a great short. Now, that's probably in the sequencing of how you would play a recession towards the back part of it. But of course, if you shorted the banks unhedged and you got the currency kick, that gives you some comfort, even if you've got initially some expensive carry to hold those banks as a short.
I should think the offshore people have actually been disappointed in their shorts in the banking sector down here. That hasn't done much.
No.
Right.
No, once you take account of
2 or 3
the
years
resilience
out.
of the currency and the carry,
Painful.
so far it's been probably a wash. They would have been better finding something else to short, I guess is the way to put it. So that's why timing is important. And that's why what's interesting, you've seen like the rate market move from saying everything's okay in Australia, which is where they were a year ago. At the start of last year, the rate market was expecting a couple of RBA rate increases, to now saying it's not so good. In fact, now the RBA is going to cut. So you've already made money by taking a glass half empty view on the rates space. And indeed, even on the currency space, I mean, at the start of last year, we forget the currency was over 80 cents. So there's been an adjustment there as well. It's the banks where it's more of a binary trade in the sense that there's not been a lot of money made from people going, yeah, this economy's softening. The real money's going to be made when they go and are proved correct in saying it's a hard landing. So the banks are more binary than some of those other options to trade Aussie macro disappointment.
Who's the first to cut the dividend?
My view is it's what deck of the Titanic are you on? If the ship hits the iceberg, let's not fuss about it. They're all going down. Yeah, I wouldn't hazard to guess, and for me, it's not that pertinent. I think they're all, as a basket, just short the lot of them. Now, the one thing is, I don't think they go bust. I mean, this is a trade on the back of dividend cuts. What has been the world's most expensive building societies, which is all they really are, they've already derated. They can derate further. They'll take an earnings hit and they'll take a dividend cut. Now that gets you a fair way lower, but I wouldn't play them to the death. There will be a level where you need to say, well, I've made my money. Let's. They're not going to do some of the GFC Lehman style go to zero.
No, well, the RBA put would be a lot higher strike, I would have thought.
No, well, that's right. Look, we know from the GFC, the playbook, they guarantee the deposits.
Yeah.
For a fee, they guarantee their wholesale funding. So effectively, they've sandbagged that side of the balance sheet.
There was a bit of helicopter money here, wasn't there?
It wasn't quite, not what I'd characterise as helicopter money. What they undertook was to...
Vouchers to Harvey Norman sort of thing, remember that?
Oh, sorry, on the fiscal side there was, correct.
Yeah.
No, that was absolutely essential. Look, the point about the GFC in Australia was everybody say it was China that saved us. I think that's complete bunk. What saved us was Lehman's going under. Lehman's going under was rang the alarms for policymakers at the time, and they were super aggressive in terms of fiscal expansion, which is, yes, helicopter money, and rate cuts. Now, what that meant was in 2009, the year the rest of the world was on its knees, we had aggregate disposable household income growth of 9%. 9%. I mean, if that's a GFC, let's have one every year. Now, of that 9%, I estimate that policymakers contributed 8%. Now, that got us through that horrible 3 quarters from Lehman's fall to the inflection in Chinese growth indicators by the middle and second half of 2019.
Plus, like Canada, the banks weren't doing anything particularly sexy down here. They weren't going to get themselves into trouble.
They didn't
on
need
a
to.
relative basis.
They didn't need to. This is the remarkable thing. I mean, with risk weighting, and you set your own low risk weights, why do all this daft stuff like the Germans? You could just lend to Aussie home builders and home buyers, and have ROEs of 20% plus.
Yeah.
So long as that didn't blow up, they weren't doing anything stupid. I mean, when that does blow up, we're all going to say, what muppets? Why were they doing that? But you need unemployment to rise for that to happen.
You know, I've been a Real Vision subscriber for a while, and I have to say I'm probably one of the biggest perma bears, according to all my mates anyway, that is in the land, including having sold the house down here, for example. But I mean, I need to have some bullishness coming out of Real Vision. So, what have you got that's bullish?
I'm bullish Japan.
Japan.
Look, I think there's a secular story there that investors are not paying attention to. In fact, I'm in my own marketing with my clients. I'm amazed over the last year. It's not that people love Japan. It's not that people hate Japan. They just don't talk about Japan. Now, I've been bullish for 2 or 3 years. It hasn't paid out yet, but I'm going to stay bullish until it does. And let me give you a quick sort of run through of the story. It starts first and foremost, in my view, with the improved capital allocation of Japanese corporates. Historically, particularly if you go back to the 80s, but it was still true in the 90s and even into the noughties, Japanese corporates just invested way too much relative to their earnings. And as a result, they had terrible ROAs. Now, they put a lot of lipstick on that pig by being massively levered. And that's how they got half decent ROEs. They weren't great, but the gap on an ROE basis was a lot narrower than the ROA gap. And that's, as I said, this massive leverage that they had. Well, that's all changed. They virtually removed the ROA gap to the rest of the world. Unlike virtually every other corporate sector which has spent the post-GFC period leveraging up, Japanese corporates have been deleveraging. There's now a massive gap between their profitability and their capex. In fact, their profits as a share of GDP in the listed sector is now at an all-time high. Capex is still quite anemic. Now, the gap between your profitability and your capex is roughly your operating free cash flow. So they're spitting in aggregate enormous amounts of cash off. So that's how they pay down their debt. That's how they are shoving a lot of cash under mattresses. That's how they're increasing their dividends, and God bless them, some of them are even doing stock buybacks. The proof ultimately is in the pudding, and they have out-earned the rest of the world over the last 5 or 6 years. So they've had better EPS growth than the rest of the world. But they have not outperformed. Now, if you grow your earnings faster than everybody else, and your stock price doesn't do better than everybody else, obviously your valuation must have compressed. And Japan's gone from a long period of being a premium market, probably without any just reason for that, to increasingly trading at a discount on a lot of market-wide measures. So I like Japan as my favourite all-weather market for the next 2 or 3 years. I think if there is a global growth acceleration, as is usual, because it is a cyclical market, it will do well. But even if things remain quite anemic, these underlying improvements in returns, balance sheet strength, and earnings at some stage should get some recognition from global investors.
I guess the offshore real money has been giving it to the Bank of Japan. They now own 80% of the ETF market. Demographics are a worry. There are a few things offshore that the currency probably gives people the willies to some extent in terms of indebtedness.
Yes and no. Let's address those in order. I think what we're seeing is partly Japan Inc. at work. The BOJ and the GPIF, which I think is still the world's largest pension fund. Now, the GPIF is doing a massive asset allocation switch out of bonds. It was massively overweight JGBs into equities. Now, if they had been anticipating that, and in a sense it was a no-brainer trade 4 or 5 years ago when JGBs were already, you knew they were going to offer you basically no returns because the yields were, guess what? No yield. Versus equity that were looking attractive. Now, if you're the GPIF sitting there going, how am I, the world's largest holder of JGBs, going to get out of this market without butchering my own book? And the BOJ comes along and says, I'll be a big buyer of equity bonds for you. You go, this is a marriage made in heaven. So effectively, one way to look at what the BOJ has been doing is facilitating this massive asset allocation switch by the GPIF. Now, in that context, their purchases of equities, the BOJ's purchases of equities, are actually quite small.
On an absolute basis?
Relative to what the GPIF has switched into, yes. Now,
do you think that should be ultra-vires? Should they be able to buy equities?
No. I think it's unnecessary. It's unnecessary. But address some of your other concerns. Firstly, the debt concern, the public sector debt concern is hugely overrated. And if you look at government debt to GDP on a gross basis, last time I looked, it's about 220% of GDP. So that's the number we use to scare the children. On a net basis, it's closer to 100. Once you take out BOJ holdings, it's about 40% of GDP. I mean, they don't have a debt problem anymore. It's been taken away. The BOJ means net JGBs outstanding outside the BOJ, net of the assets that the government's got, is very manageable. And ultimately, next time they stimulate, they probably shouldn't even go through the charade of issuing JGBs. They could just print money. The demographics, likewise, I don't think demographics are a concern. Obviously, Japan's demographics is one reason they have had low trend growth. But let's not confuse an equity market with an economy. The big change that's maybe bullish on Japanese equities are all about the improving return on assets and return on equities for the Japanese listed sector. It's almost unconnected to their economy. And in fact, if you look at the sales reported by the listed sector compared to Japan's nominal GDP growth for 20 years, they're completely unconnected. They're disconnected. And this is one of the reasons why, over the medium term, there is no correlation between GDP growth and equity returns, which is why, if you look at, for example, China, the world's fastest growing economy for 30 years, it's giving you fairly ordinary equity returns over that period. So I'm not fussed about the debt. I'm not fussed about the slow growth or the demographics. I think the story is elsewhere. And the currency, well, depends how you're worried about it. I normally look at these things on a common currency USD return basis when I do my comparisons. And what we've seen is effectively it's a hedge. When the yen weakens, the yen value, the local currency value of the index goes up, and vice versa, all becomes a bit of a wash.
Right.
So I'm not that fussed.
Now, the multiple mentions of helicopter money might bring me to the MMT story, which the Twitter sphere has gone mad with of late.
It has. I think it's the theory for the times that are a-coming. And I think there are two big shifts that are pointing to MMT or some variant of it becoming the main policy response in the next downturn, whenever the next downturn is. The first point that supports that shift is that we have exhausted monetary policy. We exhausted conventional monetary policy last cycle because we hit the zero lower bound. Then central banks tried two unconventional tools. The one was quantitative easing, which they think worked. I don't think it did. Certainly not as an economic stimulant. We can debate what impact it had on financial markets, but I don't think it worked as an economic stimulant. But even if we take them at their own face value, the central bankers are saying that QE as an economic stimulant has diminishing returns. Now, it's got diminishing returns. Just think about the maths here. Last cycle, they were able to deploy some conventional rate cuts, and then the big four banks lifted their balance sheet to around $16 trillion. Now, if you wanted to provide all your monetary stimulus next cycle via QE, you'd have to step up more than 16 trillion because you've got no conventional room to move, so all the load gets taken by QE. Plus you're telling me, Mr. Central Banker, it's got diminishing returns. So what's the number we have to do next cycle? 32, 64 trillion? I mean, we're seriously running out of things to buy. So I think QE is a failed experiment. The second unconventional tool they deployed last cycle was negative interest rates. Now, this only became, in a few, what I'd characterise as boutique interest rates. I think it too has been seen as a failure because it complicates life for your financial intermediaries, which after all are the channel by which easy monetary policy is meant to make it into the real economy. But then I think you start to hit political limits. Can you imagine how voters, pensioners would act if they really were receiving negative interest rates? There'd be a lot of tweets to Mr. Trump saying, "Can you tell Jay Powell to get his hand out of my purse, please?" This is not tenable politically. So the first reason for thinking we're heading towards MMT is we've exhausted monetary policy, both its conventional and unconventional variants. The second, and this is why I call it the theory that suits the times, is the huge political pendulum swing that we're seeing. From the early 80s, we really had a 30-year political swing towards, call it what you will, neoliberalism, the Davos consensus, the Washington consensus, and it's pretty obvious that that's swinging back. And the way it's swinging back, it will suit the people that are riding that pendulum swing back to be able to advocate for fiscal policy. Because fiscal policy in this context is not just a demand management tool, it's a tool for achieving other objectives. Now in this context, MMT as a descriptive theory, let's forget about its prescription, just talk about it as a descriptive theory, strikes me as little more than a statement of the bleeding obvious. If you issue debt in a currency that you have a printing press for, you don't need to default. Statement of the obvious. Secondly, economies have capacity constraints. Statement of the obvious. So that's two seemingly pretty innocuous statements. But once you agree with those two precepts, it completely tips on its head the conventional notion of why you tax. The conventional notion is, well, you can't spend without taxing. Well, if you just agree those 2 points, then...
Spend by printing.
You spend by printing, and the reason you tax is to prevent the private sector competing for the resources you're after.
Dragging it back, yeah.
So it completely inverts the way you look at things. Now, in theory...
But it's a domestic way of thinking. You're kind of ignoring international trade.
I don't think you need to. As with conventional monetary policy, if I was to unilaterally slash my interest rates, I know that would have a consequence for my currency, and presumably I would adjust how much I cut rates by to take that into account. Now, if I was to undertake MMT, which is money printing fiscal policy, and the active ingredient here is the fiscal expansion. That's why QE was not MMT. The active ingredient is the fiscal expansion. If I go, look, I ordinarily need to do, let's say, a 5% of GDP stimulus to get myself back to full capacity. But I know if I do that 5% stimulus, my currency will drop 15%. Well, okay, I'll only do 3 and have a 10% currency drop, and that's enough of an ease in financial conditions, if you want to characterise it as that, to hit my objective, which is having an economy running at full capacity. So I don't think there's anything novel in that. In fact, I even think what you could see is a system where, for sure, the central bank is corralled into supporting fiscal policy. And you could have an agreement between the Japanese government, let's say, and the BOJ, that the BOJ will, under every circumstance, commit to purchasing 80% of all JGB issuance. It's probably down on what they're doing, actually.
Exactly.
Anyway,
on that already.
Yeah. So that's your MMT component, and then Mr Abe can ramp up his fiscal policy to achieve whatever objective he wants. But you could at the same time say to the BOJ, but you go ahead and set interest rates to ensure you hit your inflation target. Because that ultimately can be a constraint on how much Mr Abe will print. It's his knowledge that the BOJ could lift interest rates to maintain their inflation target. So that you preserve the monetary policy independence of central banks, even if you make them subservient to fiscal policy. Now, that obviously raises the point that you could have a tension between monetary and fiscal policy. Once again, nothing novel there. Last year we had a big fiscal easing in the US and the Fed was ramping up rates. So that's not unusual at all, and it shouldn't, in theory, create any predicaments. Now, the issue with all this is this. In theory, it should work. In theory, communism is going to work. So we know in a practical sense there's a lot of potential wrinkles on this. All I would say as a card-carrying secular stagnationist, which is what I am, this is kryptonite to secular stagnation. If we fully deployed open-ended central bank support for fiscal expansion, is the day I get my secular stagnation membership card and I hand it in. It's all over. Now, that doesn't mean I automatically become an inflationista. It certainly doesn't mean some of the ludicrous comments people make about being on the road to Venezuela or the Weimar Republic are true. None of that is true. In fact, here's one trade. Go long straw, because there's going to be so many straw men demolished in this argument, you've got to go long. So it doesn't mean I necessarily believe in that. But obviously, if I'm looking at the inflation risks on a 5-year time horizon, and through most of the last 10 years, the fat tail's been the left tail, that we get disinflation or disappointing inflation. The day we adopt MMT, the right tail becomes the fat tail. And even if my base case remains that we have acceptable inflation, the balance of risks has shifted, and that would start to affect asset prices and how I would trade the market.
I guess it's the neoclassical economic school in every treasury in the world is going to be not willing to do this or change their minds.
Well, yeah, what was marvellous is if you had asked those treasurers or those central bankers what they would have been willing to do in 2005 in the next downturn, I bet you none of them said negative interest rates or QE. It's amazing how a hanging concentrates the mind. And that comes back to why I think it requires another crisis to get policymakers pushed towards this. But look, this is not coming out of the blue. We've got to remember people like Ben Bernanke have already made speeches about how fiscal policy needs to take the lead in the next cycle. And Mr. Bernanke even went to the stage of proposing something along the lines of regular FOMC meetings agreeing on the quantum of deposits they would hand over to Treasury for Congress to then spend. So this has been broached before by some respected policymakers, and it comes back to why would we go to those lengths? We've got no other option in terms of conventional policy response against a backdrop where the masses are angry. And think of it this way, Japan has led the way on most of the trends that we've seen in developed economies for the last 30 years. And I continue to think that Japan's likely to be the first cab off the rank in terms of fiscal expansion supported by central bank balance sheets. They have this fantasy in the next downturn. We have an Abe Kuroda press conference. They start off by apologising for missing their inflation target.
Again.
For the 20th year in a row. But they then say, look, says Mr. Abe, I'm going to expand the budget deficit by 3% of GDP. And Mr. Kuroda this morning deposited that cash in the government's bank account. And I think in a year's time, that will accomplish our 2% of inflation target. But I'm telling you now, if it doesn't, the 3 gets dialed up to 4. If that doesn't do it, 4 becomes 5. You see where I'm going? In other words, what we have here is a whatever it takes comment, but not a Mario Draghi, I will do whatever it takes to douse the sovereign debt crisis in the periphery of Europe. This is a Kuroda comment, I will print as much as it takes for these guys to spend to hit the capacity limits that at some stage will surely get us inflation. Now, the day that happens, you know there's going to be a whole lot of editorials in the financial press poo-pooing us. There's going to be a whole lot of people saying, yep, they're on the road to Venezuela. But I tell you what, if it works, the next time there's an election in Italy, why wouldn't someone say, this is what we're going to do? Why wouldn't Jeremy Corbyn say, I told you people's QE would work, here's the example. And it starts to spread. And if that all happens in the next 2 or 3 years and the US has a recession, why wouldn't Mr. Trump, who by this time has made Ivanka chairman of the Fed, go ahead with it?
Well, by this time the dollar's gone through the roof.
So he really needs to do it.
Oh, yeah. I mean, if they're talking about paying the universal basic income like with ETFs in Japan, you know what I mean?
Yes. Now, look, this skims over completely the debate of how you should spend the money, and that's a political thing. And of course, part of the reason there's such pushback to MMTs, it's got tangled up in specific policy proposals, and I'm not competent to debate how realistic they are or not. It's probably irrelevant to investors. But as a demand or cycle management tool that would be able to get us to inflation, I think it's obvious that it would work if done with sufficient vigour. And that's my only point I need to make to investors. Let's not get hung up about the specific proposals they are making to how to spend the money. Let's just focus on the fact that if they do this in size, we can get inflation. In other words, none of this removes the causes of secular stagnation. The high debt levels, the inequality, the globalisation, the tech development, the whatever, all continues to operate. But it's an antidote to them. It gives you symptomatic relief that means that you can push the economy hot enough till at some stage you will get inflation.
Do you want to move on to China from Japan?
Yes. Now, there's a place turning Japanese, but anyway, go on.
Just in terms of rate of change of leverage and the size of the last year, the increase of that balance sheet?
The leverage is a macro cycle concern, but I don't think it necessarily means they have a really hard landing. So long as they can, I think they've satisfied two conditions, which is most of the debt is RMB denominated debt. And so long as I think they can control their capital accounts, then if that debt does cause too much problems, too much stress, too much financial stress, they have the solution. It's called a printing press. And because if we agree with the premise that most of the debt is domestically based, domestically denominated, it's irrelevant how big FX reserves are. I mean, the fact that you've got a pile of USD is no help if you've got RMB debt problem. What's a help if you've got an RMB debt problem is an RMB printing press. Now, it wouldn't be pretty, it wouldn't be elegant, but it does mean that they will avoid that left tail risk of a Lehman's moment or a Minsky moment. So it's the good news. The left tail risk, I don't think is particularly large. Then you come back to the more vanilla risks of what they're trying to do. And on that front, the way I see it, there's good news and bad news. The good news is that the way they've tried to provide some cycle stimulus over the last 12 months has been more consistent with their longer strategic aim of rebalancing the economy away from exports and capex towards services and the consumer. That's been their strategic objective for some time. It made no sense if you were trying to get away from capex and towards services that in 2015 and 16 you stimulated by focusing on capex. All that did, I mean, it got you a short-term sugar hit for GDP, but it added capacity in a world that had too much capacity and therefore exacerbated their disinflation problems when you had a lot of debt. And deflation and debt, not a great macro mix. So that's the good news. They are doing a more sensible way of trying to deliver the stimulus. The bad news is it's harder to calibrate the effect. Back in the old system, if I was going to build $1 billion worth of infrastructure, I was fairly sure that in the next quarterly GDP accounts, there would be $1 billion boost via capex to your growth. If I'm trying to boost growth by giving some stimulus to the household sector, and let's say I cut VAT tax rates or income tax rates, I'm not sure how the consumer responds. And clearly the response over the last couple of quarters has fallen short of what they're expecting. It's been exacerbated by trade tensions. My point has been, however, that okay, if what they've done so far is not enough, they can dial it up. And at some stage you will see leading indicators of growth in China start to inflect. I think we're seeing the early signs of it now.
Already happening, yeah.
And so we will get this sense of cyclical improvement through the second half of this year. But what I'd highlight to investors is, firstly, it's going to be more modest than certainly what we saw in 09-10, but even what we saw in 15-16. But secondly, because it's been directed more to the consumer than the corporate, the spillover beneficiaries will be different. This will not be something that spills over, let's say, into the industrial and commodity complex. There are other reasons that base metal prices, bulk commodity prices have been rising. It's more going to spill over to the consumer sector. Now, this is all cycle stuff. Take a step back. Chinese trend growth is slowing. It's slowing, as I see it, in a fairly predictable fashion. It's remarkable how closely trend growth in China has followed the template set by Korea and Japan. And if it continues to follow that template, and I've got no reason to think it won't, in fact, it may be worse, because its demographics are worse now than Korea and Japan's were at the same stage of its cycle, we'll probably be talking about 2 or 3% GDP growth as the new normal for China in 2 or 3 years, 4 years' time. Whether they'll print that's another thing, but I think that's going to be a closer approximation of their genuine underlying growth rate. Now, that's not too shabby when you think their workforce is already shrinking.
Yeah.
So that actually implies productivity growth economy-wide of over 2 to 3%, which is pretty good. It's not what we've had, but it's pretty good. So we've got to get that. We have to constantly recalibrate in our own minds what is normal Chinese growth and what's acceptable to us and policymakers. Now, of course, whatever that number is, there's a gap between what they actually print. But if you get a grip on the true underlying number, it's coming down quite sharply.
And you think they start to weaponise the currency a bit more post the trade talks, or
look,
what do they do with it?
I think what we've clearly seen over the last 2 or 3 years is the start of what's going to be a structural grinding together of geopolitical stress points. I mean, what we're seeing is clearly bigger than just trade. It's bigger than just Trump. It's bigger than just America. And I think the game changer for a lot of people outside China was Xi Jinping appointing himself emperor for life, cracking down on the green shoots of a liberal political system, because the deal from the West always was, well, look, we'll turn a blind eye to you cheating and thieving on trade and other things and your human right abuses on the basis that as you get richer, you get more like us. Well, they'll stop looking like us. And so to a certain extent, the gloves are off. And I mean, as an illustration of the fact that it's not just Trump and it's not just the US, I mean, look here in Australia, which, you know, the caricature from most other parts of the world is that we are just an extension of China. I don't think we are, but that's the view, the caricature a lot of people have. Taking the lead in banning Huawei's participation in the 5G network here, taking the lead in the crackdown on Chinese, we didn't call it Chinese, sorry, foreign political influence. Who would that be directed at? So, I mean, that shows that, particularly, I guess, the Five Eyes are all concerned about what's been going on. And these tensions will continue well after Mr. Trump's left the White House, I think.
And therefore the currency?
Yes, weaponising the currency, absolutely. Now, look, I think part of that, whether you call it weaponising or arming it, because I think one of the things that perhaps the US has been a little foolish on is the degree to which it's weaponised its own currency. And I'm not talking here so much about, you know, the absolute level as a macroeconomic tool, but weaponising it in quite specific financial ways to bring down a Russian company, to use its power as the dollar as the world's reserve currency to achieve political aims. And what I think you're seeing is certainly the Russians, certainly the Chinese, but even to a lesser extent the Europeans going, whoa, if they're going to use that in ways that breach the old understanding, which is we have a global regulatory infrastructure that we all basically abide by the rules, and you, Mr. American, have a privilege because we're using your currency as the benchmark, but ultimately you don't overstep the mark. Okay, pick on your Venezuelans if you want, but you don't pick on the big boys. Now that they've weaponised the dollar to effectively pick on the big boys are going to go, right, how do we get around this?
Like no OPEC.
Correct.
Right.
Part of it was the walking out of the Iranian deal and threatening sanctions against European trading partners. Whoa, hold on.
Calm down.
That's right. So I think that there's two elements to this. Yes, the Chinese will start to use whatever tools are available if the tensions really start to escalate. But part of it's been the rest of the world also looking at the way the dollar has been used under the current administration and going, well, if that's the way this is going, we need to build our own defences.
Well, they're chipping away at the petrodollar with a new futures contract, for example.
Yes.
Yeah.
Denominating trade in non-dollar currencies or setting up, effectively what would be SUVs, dollar-based SUVs that sit outside the US financial system. We have this. Look, we've seen this before. This gets back to the whole creation of the Eurodollar market back in the 60s to escape American regulation of the currency. So this is not without precedent, but that was a commercial motivation. This is much more a political motivation.
Interesting to see where it all ends up in the end game. China is looking to become the global reserve currency, clearly.
Yes.
Eventually, but it's a 25-year trade.
But potentially longer. Here's the interesting thing. Will you ever be accepted as the world's reserve currency if you don't have what we normally associate with it, an open capital account?
Law. Enforceable law.
Correct. Of course, you can always bully your way into, if you're the world's largest purchaser of, let's say, iron ore, to say, well, I'm going to pay you in RMB. Okay, you can bully your way that far. But that's quite different to having a global system with an RMB base. And this gets to the tension of where we are now. If you think China's progression towards a westernised liberal polity has stalled, then the forecast of it becoming the world's reserve currency, one of the most important, I think also has to be pushed back because I think they may be incompatible. But there are other options. And
currency-wise?
Well, to a more multipolar currency, which comes back to what would happen if the US does get very aggressive, unreasonably so in the perception of other people, in weaponising its currency, and just as it shrinks as a share of global GDP.
It all points to capital controls all over the place at some point to me.
At some point, the interesting thing would be, say, with the adoption of MMT, is if it was broadly done at the same time, there's only one thing paper currency goes down against, GOLD.
Yeah.
But if someone tries to do it unilaterally and then has capital controls, the fact that they think it's necessary to have capital controls probably means they've pushed the accelerator way too hard, and that is where you start to get bad things happening. So long as they allow either an open capital account so the market can express its displeasure by selling off the currency, or it's better to have them both, if you kept central bank independence so that they could lift rates if the fiscal authority got too loose, then you have something that's sort of semi-workable, I think. Not without its risks, but at the end of the day, we've got a current system that's not been without its risks. You look back at the operation of monetary policy over the last 30 years, and I don't think anybody's going to say they've done a stellar job.
I think we'll be happy to leave it there. Thank you very much indeed for your time, Joe.
You're welcome.
Look forward to seeing you again on Real Vision.
Thank you.
Thanks.